Welcome to Accounting with Madam Mumbi. Today we are going to look at accounting cycle, that is the whole process of recording transactions, classifying them, summarizing them so that we are able to do from journals, posting into the ledgers, from which we are going to derive a trial balance. The trial balance, after the trial balance, we are going to do end of year adjustments, and finally we are going to do financial statements. So to start with, we are going to look at journalizing. So an introductory part of this tutorial that is very fundamental and very important is to know the financial statements elements. That is the elements of the financial statements. Why is it so? We cannot do journalizing or posting to the ledgers without knowing what is an asset, what is a liability, what is an expense, because all the business transactions relate with these elements of the financial statements. So to start with, we are going to look at what are assets. Now, assets are resources that are controlled by an organization. They result from past events, and they are expected to yield benefit to the organization in the current period and in future periods. So these are resources that the organization controls, but from which they are able to derive an economic benefit. Assets can be classified into fixed assets, also called non-current assets. These are the assets from which the organization can derive benefit for a long period of time. Several of them, other than land, are depreciable, that is, they depreciate over their useful life. A number of fixed assets, or what we have called non-current assets, some of them would be machinery, motor vehicles, furniture and fittings. All these represents the fixed assets or the non-current assets. The benefit that can be derived from these assets is in the current economic period and also in the future periods. We can also have current assets. Current assets, these are assets that are consumable, sellable, or convertible into cash within a short period of time, usually within 1 year, one physical year, or one accounting period. And these ones, the current assets, they represent items like cash, either cash at hand or cash at bank. They also represent or include debtors, or what we also call trade receivables. It also includes prepaid expenses. They are also part of the current assets. We are going to look into further into what those are. So we have to understand which elements represent assets in the organization. The second element is expenses. Expenses, these are costs that are incurred by the organization in order to earn revenue. So the costs that are incurred in the organization to earn revenue are the ones we are calling expenses. Now, the difference between expenses and assets is that expenses, there is no future benefit. Once you pay for it, you do not derive a future benefit. For example, if you pay for salaries for this month, it does not mean now you're going to benefit from that payment in the next month. You also have to pay for the next period. Salaries have to be paid even in the next period. Also, expenses largely in profit-making organizations are related to the revenue. Rather, they are incurred in the generation of the revenue. So that is expenses. The next item is revenues. Of course, these are cash inflows coming into the organization. Number one, from the trading activities, the normal activities of the business. For example, if a business offers services, the money received from offering those services is what we are calling the revenue. If a business deals with supply of goods. The sales of those commodities, the money gotten from the sale of those commodities is what we are calling revenue. Other revenues would also include rental revenue or rental income. This is where maybe a business has a big facility, maybe a building that it is not utilizing. It may give part of that building to other people or rent it out to other people, and they are going to be receiving rental income. Another income or another revenue would be discount received, where a business buys goods in large batches, and maybe they benefit from quantity discounts. So revenues represent the inflows to the organization from the ordinary course of business and from all other use of assets that is beneficial to the organization. The next item is equity. Equity can also be equated to the capital or the owner's interest in the business. It is how much the owner has invested in the business. It is how much of the assets that can be attributed to the owner's money. So that is what we represent here as equity or capital. Finally, the last element is the liabilities. These are obligations that are payable by the organization in the future. Now, what do we mean by obligations? For example, if the organization has bought goods on credit, so they have bought goods from suppliers on credit, they have not paid for those goods, what we have there is an obligation to pay in the future. If the business has gone to the bank and taken a loan, what we have there is an obligation to pay the loan and the interest in the future. So liabilities are obligations to other people outside the organization who are not the owners to pay them from our assets or from our resources in the future for the amount either borrowed or for the goods bought probably on credit, just to mention a few of the obligations, or any other amount that is outstanding. Again, liabilities can be broken down into two. We have current liabilities, payable within a short period of time, maybe 1 year, like creditors. We can also have non-current liabilities that are payable for a longer period of time, like debenture loans. So, having understood these elements of the financial statement, that will bring us now to our first step of the accounting cycle, which is journalizing. So, to be able to understand journalizing, I want us first of all to understand these rules of double entry. The rules of double entry, they are rules that help us to know which account to debit and which account to credit. Also, they help us to know what happens when there is an increase and when there is a decrease. So looking at it, the word that we use to be able to remember or to categorize them is what we have here. The first letter is dealer. So you have a dealer. Dealer stands for, D is for drawings. The first E is for expenses. A stands for assets. That is the DEA. On the other part, you have L for liabilities, E for equity, and R for revenue. So, with this dealer, now we can come into the issues that are inside here, or the rules of double entry. We find that for the first three, that is the drawings, you have the expenses and the assets. That is the first three. For all of them, the balances are debit balances. So these accounts, you debit the balances, or they have a debit balance at the beginning of the period. And anytime they increase, you also debit. So anytime they increase, you also debit. But anytime they decrease, you credit. You credit. So that is the first three, and it is common. It is a modern approach. It is a rule that for drawings, expenses, and assets, The balances are debited and the increase is debited, while a decrease is credited. Okay, looking at the other three, that is liabilities, equities, and revenues, the opposite is true. The opposite is true. For liabilities, equity, and revenue, their balances are credited. So they start with credit balances. For an increase in the three, you credit, and any decrease, you debit. So I would like you first of all to understand, or rather, to get to know these rules of double entry or the rules of debiting and credit, so that when we are going to be able to do journals, you can easily and quickly understand. So the next item now is to look at this question. So we have a question here whereby it requires us to prepare journal entries. Also, we are going to prepare some ledgers, and finally we are going to extract a trial balance. Now you can copy the question probably, so that because I will not be able to display the question and the answers together, but make a copy of the question so that you can be able to follow on how to answer the question. So to begin with, it says that Bright Enterprise is a small agribusiness venture started in March 2023 by women entrepreneurs in Meru Town. The following are transactions of the business relating to the month of March. On 1st March, they started a business by depositing 20,000 to the Enterprise Bank account. So, the first item or the first journal is going to relate from this transaction that occurred on 1st of March. When we do journals, we want first of all to identify the transaction. We also want to identify which accounts are affected. Then we are going to determine what type of accounts are those. Now, in this 1st of March, what we can see here, there are two accounts that are affected. One of the accounts that is affected is capital, because the money that is raised to start a business is called capital. The other item or the other element that is affected is the bank. Now, going back, having identified that we are going to be affecting the bank and affecting capital, I want us to go back a little bit and look at them here. I want us to go back and look at this, our rules of debiting and credit. We are saying that the affected account, one of them is bank, which is an asset. There was no money in the bank before. Now there is money in the bank. So what we can say is that the bank has increased. Therefore, we are going to debit the bank. Again, capital, which is also affected, is what we have here as equity. There was no equity in terms of the business was not yet started. It is when it is starting. Therefore, it is the first time you are introducing capital. So again, we can say that the equity to begin with should also be credited. So here you are going to find that we are going to debit the bank, and then we are going to credit the capital. And that will be our first journal. So our first journal from this transaction is going to be as follows. This is our first journal on 1st of March. We are going to say debit the bank. So this is debit of the bank, 20,000. And then you're going to credit capital, 20,000. We also put a narration or a description of what has occurred. So we are going to say that the transaction here, or what has occurred, is that cash has been deposited to start the business. So from that, we can see that there are two accounts being affected. One of them is bank, while the other one is capital. So going back, we can look at the second transaction. On the 2nd of on the 2nd of March, he bought goods for resale on credit from Clifford. So, again here, when we buy goods for resale, the account that we use is purchases. So, the first account here being affected is purchases. Then the other account being affected is Clifford account. And here, Clifford is a creditor. This is somebody we owe money. How do we know that we owe him money? Reading through the statement again, you find that we are saying goods bought for resale on credit. Credit means they were not paid for. From Clifford is shillings 29.60. So from the person we bought from is called Clifford. Now, again this transaction we start by identifying which accounts are affected. We have said if goods are bought on credit, the account that is affected is the creditor's account and also the purchases account, because we are purchasing goods for resale, but we have not paid, creating a creditor. Now, again going back to our equation or our rules here, now in our mind we have two things. We have purchases and we also have creditors. Purchases is an expense. So purchases represents an expense. So purchases is going to be debited. Then creditors represents a liability. So creditors represents a liability, therefore it is going to be credited. So you can see that in every transaction there is a debit and a credit. And from these rules you are able to tell which account to debit and which account to credit. So this brings us to this, that on 2nd March, the account to be debited is purchases, which is an expense, and the account to be credited is Clifford, who is a creditor or an obligation to us. We have to pay in the future. I hope so far you understand. So we can also see number 3, or what happened on 3rd of March. On 3rd of March, he bought machinery by check, shillings 2,800. Identifying the transaction here, we find that bought machinery. Number 1, the first account being affected is machinery. Paid by check, the second account being affected here is bank. Now, machinery and bank, both of them are assets. Yes, both of them are assets. Machinery is a fixed asset, bank is a current asset. So what do we do now? What we do is that we come here, again come back to our equation, we say that now our account or our transaction is affecting two assets. One of them is increasing, the other one is decreasing. When I say two assets here, we are saying it is machinery. Machinery is increasing because now we have bought a machinery, we did not have one before. So machinery is increasing, we are going to debit. The other transaction or the bank is decreasing. Remember, the bank is also an asset. It is decreasing. We had money in the bank, it has reduced because we have bought a machinery. So we are going to credit. And you can see here when an asset decreases, we are going to credit. So in this case, our transaction is affecting this line, only assets. One asset is increasing while the other asset is decreasing. So that is what we are going to do. So you can see our journal entry number 3 here. On 3rd of March, we are going to debit machinery, 2,800. Then we are going to credit bank, 2,800. So I hope you understand up to that point. The next transaction is on 4th. He withdrew shillings 1,000 from the bank for personal use. So here we are saying the proprietor has withdrawn some money for personal use. That money that is withdrawn for personal use, we call it a drawing, because you invested. Drawing is a reduction of capital. You invest money today, tomorrow you withdraw. So drawings is a reduction of capital. So we are saying here that the proprietor has withdrawn some money for personal use. Which accounts are being affected here? Number one is drawings. From withdrawing, we see that the first account is drawings. The other account being affected is bank. The money in the bank has also decreased. So we have two things here. We have drawings and we have an asset called bank. So coming back here, we are saying that drawings have increased. There was no drawings before. There was no money or asset taken over by the proprietor before. But now drawings have increased. So we are going to debit because a drawing has increased. At the same time, the money in the bank, which is an asset, the asset has decreased. So we are going to credit. So we are going to have here a debit to the drawings and a credit to the bank. That is what our fourth transaction looks like. It's what we have here. Sorry. It's what we have here, that on 4th of March, the drawings are debited while the bank is credited. So, the next transaction on 5th, it says that he sold goods on credit to J. Simon. Sold goods on credit to J. Simon. So, here two accounts being affected. One of them is sales, because you're making a sales. The other account that is being affected is a debtor, because the person to whom we are selling the goods is not paying up front. He will pay for it later. And this is now creating somebody we owe money. Oh, okay, sorry, somebody who owes us money. So what we are going to do, again, is to identify that a debtor is an asset. Debtor is equivalent to cash. It's just that that cash has not been received. It will be received on a future date. Therefore, in that way, we are going to say that we have one asset being created here, which is a debtor. At the same time, we are doing a sales, so we are creating a revenue. And from our rules of double entry, which I hope by now you have a copy of, we are going to say there is an increase in the asset. Therefore, we are going to debit debtor. And then there is an increase in revenue. Being here the sales, again now we are going to credit the revenue. So that is from the rules that we have already talked about. On 22nd, we have there J. Simon has paid by check 1,000 as part payment of the goods. So in this case now, we are receiving some money from J. Simon. Once we receive some money from J. Simon, again, which accounts are being affected here? We have the bank and we have J. Simon. In the bank, money is being received. Therefore, an asset has increased. We debit. Our other asset, which is the debtor, who owes us money, now the money he owes us has decreased. So our other asset, called the debtor, has decreased, or the amount of money we want from the debtor has decreased because he has paid some of it. Therefore, we are going to go to the account of J. Simon and credit, because now the amount that he owes us has decreased by the amount he has paid. So again, these are two assets. One is increasing while the other asset is decreasing. So our last transaction on 29th, we see here that he paid Clifford by check shillings 2,000. Now, if you remember, Clifford was our creditor. We had bought some goods from Clifford on credit. Now, here comes a time we have to pay. When we have to pay, the two accounts here being affected, number one is the creditor Clifford. The other account is the bank. Now, the amount of money that we owe to Clifford is going to reduce. Therefore, we can say that the creditor is going to reduce. Also, our money in the bank, the amount of money we have in the bank is also going to decrease. So our asset called bank is going to decrease. Now looking at that, we can agree that when you look at our rules of double entry, when a creditor decreases, we are going to debit. So we are going to debit Clifford. And then when our bank, which is an asset, decreases, we are going to credit. So we are going to debit Clifford, which is a creditor, and then we are going to debit the bank. Now, this is part 1 of the accounting cycle. Watch out for part 2, where I'm going to be covering the ledgers. And from the ledgers, we are going to draw the trial balance. So those other items, that is the ledgers and the trial balance, they are going to come from these journals that we have prepared. So far, if you have liked this video, found it important, like, share, and subscribe. Look out for the next one.